What's up, everybody? Happy Monday. And it is Monday, so as usual, I will be finishing up this week's issue of MMT Trader. It will be out later today. For those of you who would like to get a copy and you are not a subscriber or not currently on a 30-day free trial, go to my website, pitbulleconomics.com, and sign up for a 30-day free trial. In the meantime, you can get all the back issues. All right, I want to talk about a couple of things today. First of all, one of my main themes over the last, almost 3 years, 2.5 years, has been the sell-off in the bond market, the rising trend of interest rates. Now, let me take you back to December, even November, September of 2015, when the Fed back then announced that it was going to reverse monetary policy and start raising interest rates. It had signaled to the market back then that in December of 2015, it would begin a gradual program of rate increases. This would reverse policy that had been in effect since 2008. So policy which had been in effect for 7 years. Okay, rate cuts, asset purchases, quantitative easing. The Fed had signaled to the market, told investors that it was going to start raising interest rates. Now, at that time, I was not publishing MMT Trader. I started publishing that in 2016. But I was a contributor to Real Money at thestreet.com, and I wrote back then, also I made a lot of videos, that the beginning of a bear market in treasuries was about to start. I also said that the dollar was about to enter into a long-term decline, and I said inflation would begin a new upcycle, and you have to own gold and commodities. Okay, all that was a very, very correct call, and it was all based on policy. The understanding that the reversal in monetary policy from rate cuts and quantitative easing and asset purchases to rate increases would be inflationary, and the rate increases themselves would actually end up driving a rate hike cycle due to the belief by the Fed and other central bankers that higher interest rates squash inflation, when in fact they don't. They actually increase inflation by virtue of the fact that rate setting equates to price adjustment. I've said that in the past. Higher interest rates equate to higher prices because the cost of credit is reflected in the cost of all goods and services. Number one. Number two, since the government is a net payer of interest, rate increases necessarily equate to fiscal expansions. The government spends more on interest, and that flows to income without necessarily an offsetting increase in economic output. So all that stuff was true. So you see now, and all of my subscribers and people who have been following me, they know that the one really, really big call that I have had, aside from the dollar going down and gold going up and all the other accurate calls that I have made, the inflation cycle, the one really, really big call that I have stuck to, which took a little time to get going, has been the short Treasury rising interest rate call. Well, the rising interest rates were happening, but the short Treasury. But we start to see this happening now. And for those of you who have been with me over this time and have been in this trade, and I have been working with you, many of you, very closely, just to, kind of keep you confident and tell you to have patience that this would turn out the way I saw it, and it is starting to turn out the way that I forecast. We now see 10-year Treasury yields at the highest level in 4 years. And I know many of you have posted up comments here, and I've seen emails that have been sent to me saying, well, Mike, that's not really true. The Fed doesn't control bond yields. That's the market. Nah, it's not. The central bank is the monopolist rate setter. It can set the rate anywhere it wants along the term structure by virtue of the fact that it has the unlimited ability to buy government securities. And really, all that's necessary for the Fed to do is to state a rate, and the market would converge to that rate almost overnight. If the Fed said tomorrow that it wants the 10-year Treasury at zero, guess what? The 10-year Treasury is going to zero. If it said it wanted the 30-year bond at zero, guess what? The 30-year bond is going at zero. That's how it works. That's how, a monopolist has the ultimate power over price setting. So many of you have been in this trade and you have been kind of antsy and lacking in patience, and I have helped many of you just kind of stay focused, telling you that this will play out the way I see it playing out and the way I have been telling you it's going to play out, and indeed it is happening that way. And let me just say this. We are in the very early stages of this trend, of this cycle, simply because the central banker belief system, the central banker orthodoxy, and it's what they have been taught, and it's deeply ingrained in their minds that higher rates squash inflation, when in fact it is the opposite, as I just explained. So as these rate hikes continue, the pressure on prices to move higher will continue. The pressure on the Fed, or the Fed's position on its rate hikes, will become more aggressive. They will accelerate, and you will start to see almost a parabolic move in the rate cycle and a similar move down in the US dollar and higher inflation that will come with it, etc. Now, very few people understand this link. I see now some people kind of catching on to the rise in bond yields, and I've seen every explanation in the book flying out there. I mean, people talking about, oh, well, now you see that's the debt coming back to haunt us. It's not the debt coming back to haunt us. That has nothing to do with it. It's the fact that the central bank, the Fed, is raising interest rates, and it will continue to raise interest rates. And by the way, higher rates are not bullish for the currency. For the millionth time that I have stated this, higher rates do not squash inflation. For the millionth time that I have stated this, higher rates are not bearish for gold. For the millionth time that I have stated this. Now, you can believe that, or you can choose not to believe that, but if your choice is the latter choice, thank you for giving me your money, because that's exactly what is happening. And those of you who have been with me for this length of time and have followed on these forecasts, you know that your accounts have been going up. And that's really the bottom line to all of this. So, the inflation trade, the bearish bond trade, which I saw well before anybody else, for the correct reasons, not because I just said, oh, it's going down because we have too much debt. That's nonsense. The fact that the monopolist, the central bank, is raising rates, that is the reason why it is going down, and it will continue to go down. So just wanted to put that out there today, folks. As I said, I'll be busy writing the new issue of MMT Trader, and if you want that report, just go to my website, pitbulleconomics.com, and sign up for a 30-day free trial and start, A, making some money, and B, start educating yourself and becoming informed, because information, understanding, knowledge, those are very important to success. They're not the ultimate thing. You got to have mental game, which I teach, but you need to have knowledge and understanding as well. See everybody later. Bye-bye.